Maybe I'll combine these two. We'll see how it goes. But I think we will combine these two into one test. Neither one of those are as heavy as, say, the cash exam. And then maybe combine these two and do a test. And again, these aren't, I mean, there's nothing, they're easy, but I think cash is probably the most involved of all those. All right, so having said that, let's go to this one. Okay, so we ended up with the confirmations. And you recall that we had the negative and the positive confirmations. The positive confirmations are better. Do I have that up here somewhere? Yeah, so positive confirmations are better evidence. They're also more expensive though. So there's a cost factor a lot of times to them. And generally you use it if there's fewer accounts and high dollar amounts, especially if those accounts, if any of those larger accounts are material. If an account is material in and of itself, a positive confirmation. Negative confirmations are for many low dollar amounts. And by the way, you can mix and match these when you're doing an audit. You don't have to stick with just one. You can, but you don't have to. So if you have a few really large accounts and a whole bunch of little accounts, you can mix these up. Positive confirmations are usually done by invoice. You usually list the invoices on there. That's usually the easiest for the client's customers to trace. Okay, we get this bill for $1,200, whatever it was. It's easy for them to trace that. The CPA exam, they talk about blank confirmations. I've never seen one. A blank confirmation is when you send out a confirmation and it says, how much do you owe us? And they send that back in. It would be, they according to the ACCT433, this is the highest level. I don't know how they come up with that, because I know if someone sent me that, I don't know, it's $12 or something, but according to them, that's the what you should do. I've never seen one, but anyway, and negative confirmations. There is something else about confirmations, and that is, if you don't think that the customers are going to respond to them or respond truthfully to them, you may use other ways of confirming accounts. So anyway, that's kind of rehashing it. Positive confirmations are better. You have to retrieve every confirmation has to be returned, and you have to chase them down. And the negative ones are cheaper, but they're not as good because they only send it back if there's a problem. And what you have the problem with that is you don't even know if the person actually, if the customer actually got it, or they got it and they rolled their eyes and threw it in the garbage can. You don't know. So especially for negative confirmations, the big kind of hit on these is that you don't know that they have it. And second of all, that you can't really make any conclusion on the number you get back. If you get back 5%, that doesn't mean only 5% are wrong. There could be 30% wrong. It's just that you only got back 5% of them. Whereas if you're doing the positive ones, if there's 30%, you're probably gonna get back 30% because you can get them all back. Okay. So now this, if you go to, I don't know if it's page 6, my spacing may be wrong, but letter J. And this is true of all audit stuff. And that is, what happens when you do a test? You say send out these all these documents, and you get back people's the customer's responses. And a couple of things. One of the things is, as an audit, you are required to clear things that are anything there's a question on, you have to clear it. So if they returned a confirmation and it says this is wrong, you have to verify that it's wrong. They could be mistaken, they could be lying, it could be whatever it is. So even though you're getting this from a third party, you're required to clear each one of those that you get back. Okay, so again, when you get this stuff back, and two, you should know you're dealing with the public and all that, and that some people are completely sane and some people are not so much. Okay, so let's go through here and see. Before I even start, let me talk about one more thing before I think I said this before, but maybe I did. The most important document, one of the most important documents for accounts receivable is going to be the bill of lading. Bill of lading, proof of delivery, and proof of delivery not as much, but the bill, especially the bill of lading, because the bill of lading shows that there was an effort, that it was, that it should have been shipped by 12/31 or whatever the year end is, and that there was at least that there was an honest effort made by the client to believe that this is an actual sale. And if their customer didn't get it, that's kind of another issue. But it shows that there was an honest effort made to get them their stuff. So a lot of times how would you clear this? A lot of times you would clear this by looking at the bill of lading. If it's a problem with the payment, so one is if they receive the item, a lot of times the bill of lading will be there. If it has to do with a payment, going back to chapter 10, you generally clear that with the checklist or deposit slip on whatever day that they, or close to whatever day that they said they mailed it, so that you can trace and see that they actually sent whatever the check is if there's a problem with the payment. All right, so let me just write those down. So general problems with cash management responses. If it is a shipment problem, usually if it's a shipment problem, a bill of lading will be usually the one that you'll look to see if it was actually shipped. You may look at a proof of delivery. Let me spell it. Problem with pricing, probably look at like a sales invoice. Problem with pricing, probably look at like a sales invoice. Yeah. Yep. So problem with pricing, you may look at a sales invoice. You might also look at a purchase order. Problem with pricing, look at a sales invoice. You might also look at a purchase order. Yep.
Do you hear that, Professor?
What's that?
You're echoing. Do you hear that, Professor?
What's that?
You're echoing.
Okay, I'm not sure what to do with that. Okay, I'm not sure what to do with that. I was answering myself. Wasn't that kind of cool? Okay, let's see. I was answering myself. Okay, let me see here. Just get something out of here. Okay, let me see if I'm echoing now.
Doesn't sound like it now.
Okay, sorry about that. It's like that film of Lou Gehrig, you know. I'm lucky as yeah. Okay. I gotta show my screen again. Okay, so problem of shipment. You know, look at the bill of lading, proof of delivery. Problem with pricing. You know, so if they say, you know, the invoice was wrong, the price is wrong, or whatever. You look at the sales invoice and the purchase order. Now the purchase order, should match those two. So the purchase order and the sales invoices, the prices should match. If they don't, there's a problem. You know, because usually the purchase order will have the price, and the sales invoice should have the price, and if they don't, problem with payment. Look at the checklist. Deposit slip. Not the bank statement. The bank statement won't have the individual payments on it. Another way that you can clear a lot of accounts is to look for subsequent payments. Let's put it on subsequent payments. So for instance, if there's a question on any one of those, if it ends up in the cutoff bank statement, well, that would be some evidence that those actually exist. So if you get someone saying, you know, well, this amount is wrong, you know, we didn't owe that amount of money, whatever. If you know, a lot of times if you look at the subsequent bank statements, if it shows up, that's evidence that it actually did occur. I'm echoing again, aren't I? You know what? Maybe I don't know. I'll turn my speakers down. Hopefully that'll. Oh, echo cancellation. Aggressive. Okay, if my voice is cracking up, let me know. If it, you know, if it starts stuttering or whatever. I used to start one as a kid, but you know what I mean. It goes out and in. All right. So the subsequent payment on the cutoff bank statement, that's more evidence that maybe something is. It's a verification of the count or the amount of it, say. Okay. Other steps to clear audit information responses as of 12/31/21. We never received the last shipment. How are we going to clear that?
The BOL or the shipping list.
Yep.
Fine.
So, bill of lading, proof of delivery. Now, the proof of delivery, again, you know, it may have gotten lost in the shipping or whatever. So the real one there, though, that you want to, is probably the best, I would say, is this bill of lading, because that actually shows that it should have been on the, you know, it was shipped out as of the end of the year, you know, 12/31 or whatever it was. Okay, oh, here's one I didn't go over. About 3,500 of this invoice had been returned on 12/9/2021. I did not go into that one. Returned merchandise. Return merchandise. You're going to look for the receiving report. The receiving report from the receiving department, there should be some kind of a receipt for anything that was returned. And basically sorry. And basically the everything that comes in the receiving department needs to have a receiving report made with it. So this one would be a receiving report. You're going to look for the receiving report. And if you find it, you may also look at the subsequent accounts receivable procedures for it. And what I say by that, you know, sometimes, you know, people return stuff that, you know, was the wrong stuff. It wasn't ours, you know, whatever. I mean, we in your business, you see all of it. Someone will send back they'll order an engine, they'll send back a blown up engine to the return, you know, all kinds of stuff, crazy stuff happens. But anyway, yeah, so you know, you also look at the process. You know, if there's a receiving report for it, then there may also be a process as far as what to do with that once it comes back in, because there's usually some kind of an inspection or whatever, certainly a count of the stuff coming back in the receiving report, and you know, how they actually resolve that. This one's a funny one, number 3. I already paid this on 1/6/2022. The check number was 14288. So this is the accounts receivable verified responses as of 12/31. Oops. So this person said, whoever their customer said, I already paid this on 1/6/2022.
Wouldn't that be a checklist or a deposit slip?
Yeah, it would be, but yeah, but you can also look at it another way too, though. Certainly you can check and see that it was, sent. But this is sort of a verification of that it was a valid accounts receivable on 12/31. This is one of those weird ones that, hey, I already paid this. I paid, because the confirmation is of 12/31. Someone may say, well, I already paid this, even though they, it really was a confirmation of, yeah, I did owe that on 12/31. And yeah, you can look at the checklist, deposit slip, and a cutoff bank statement too, if they have it, depending on how, if you go 10 days or whatever into it, maybe it'd be on there. But number 4. Not our order. The entire order from 12/12/21 was returned on 12/15. This order was another customer's order. Your company is stupid. What do we do with that?
Check AR.
Yeah, you definitely look at the the receipt report for it being returned first of all. But this one, it may have looking for a problem with AR, in fact, or with sales. This might highlight a bigger problem that they have of possibly somehow mixing up customers and what the procedures are for updating the customers and verifying that these, the customers are the purchase orders and all that. Without looking in it, you don't know. It could be that there's 2 customers that have very similar names or something like that. But anyway, yeah, you definitely look at it, do the same thing you do for the other one where you turn. But this one goes a little bit further. This one says, okay, there might be a systematic problem in that, here we are shipping out orders to people, to the wrong customers. How does that happen? So, this one is probably of all these, this one's probably the most serious one because it points to a possible system problem, which, isn't just a one-off customer thing. Number 5, this total seems too high.
The sales invoice or purchase order.
Yeah. Yeah, you probably go with the sales invoice or purchase order. Yeah, and you may just you may also verify it with the bill of lading just to see what was actually sent to them. So you may also look at the bill of lading. Number 6, for company policy, we cannot disclose any private information regarding our vendors. Those companies that's run by lawyers.
I was going to say your lawyer.
So what do you do with that?
I guess bill of lading, right?
Yeah, certainly go to the bill of lading and probably match it up, the bill of lading, with the the purchase order and the invoice would probably be. And by the way, in the U.S. standards are that we have to do, we have to send out accounts receivable confirmations, but international standards, don't. International standards says if you want to just look at the look at the bill of ladings and match them up with the sales invoices and the purchase orders, or whatever, that's fine. So what we're doing here is really not, going around the idea that, there's problems with these accounts, but you're just verifying whether they are what they say they are. Okay. we picked up this order at will call and paid cash. We don't owe anything. A copy of the cash receipt was included in the return envelope. Okay, now, first of all, should probably go into what will call is. I don't know if you guys are familiar with that. Let's say there's a business that ships stuff all over the United States or the world or whatever. They may have local customers that say, look, I live in the same, we work and we're in the same city you're in. Can we just come over and pick it up? And that's a will call. And so they make their orders. It goes to will call. They send a truck over, to avoid shipping, and then they send a truck over and they pick up the stuff, and they may very well pay for it at that time. They could be on accounts receivable, but it also has to be paid cash. So will call is local businesses, usually, or customers saying, look, don't ship it, I'll just send over, we'll go over with the truck and pick it up. And so that's what the will call is. So this one is, we picked this order up at will call and paid cash. We don't owe anything. What's the problem with this one?
It's very shady.
Yeah, your immediate question is, well, what happened to the cash? This is your immediate question. And so this one would take a little bit more effort to go through. You'd look and see if what the cash deposits were for that date. It could be that the cash deposits, were okay. They just entered it as accounts receivable and they didn't match up, and nobody checked on it. Which would tell you that could be a system problem, that whatever's in the cash should match up to the cash sales for the day, and go in intact. So yeah, this one's a little bit trickier in that it also makes you wonder if someone isn't taking the cash and then putting it as an accounts receivable. And you probably have to look more at the procedures in will call and see what they are, if they're up to snuff. But by the way, this is one of the reasons why you do these. You cannot see what I'm doing. So this is one of the reasons why we do these things, though. This is why we want a good example of why we send out these accounts receivable. You may not know there's a problem at will call with cash purchases, especially with cash receipts. So this is one of those things that, this is exactly why we do in the audit like this, is that you actually get information of where there may be a problem, and that's where you want to look. So this one would probably be one of the ones that you'd probably want to look at, take a good look at and see if there's a system problem. So of these ones that we have here, this one is probably one we want to look at because it could be a system problem. And this one is one of those ones that you go, okay, well, wait a minute, this is more than just hey, it got lost in the mail kind of thing. That it could be something more, it could be more prevalent than just what you got here. Okay. The last thing we're going to do for this. Okay, one of the things that you'll always hear about is people talking about getting a cutoff, and you say, okay, what does that mean? What does it mean to get a cutoff? A cutoff of sales or shipments or cash or whatever it is. How do you determine what that what they call a good cutoff is? And you need to get a good cutoff at, well, you do it at year end, but notice you get at year end, that means there's a good cutoff at the beginning of the year going into the next year too. So, you really focus on that cutoff at year end, and it's to make sure that you get all the revenues and the expenses and so forth in the correct period. So all those, revenues and expenses should be in the correct period. And especially things like accounts receivable, which are, directly related to sales. Do I have any room here to do this? Yeah, I'll put it up here. You know, you notice that the journal entry for sales is going to look like this. Yeah, whatever number. So if their accounts receivable are overstated, it's pretty much assured that their sales are going to be overstated, which overstates income. And you know, so if there's a problem, it could very well overstate the net income.
Hey,
Yeah,
Professor,
so if there's a problem,
hey, my
it
screen
could
is
very well
frozen.
overstate the net income.
Can you hear me?
Yeah, so I was getting the echo. Yeah, yeah. I was getting the echo. Okay, let me. This is really annoying.
It's not frozen anymore, but you're a little bit delayed.
This is really annoying. Yeah.
I can hear you.
Okay, yeah, but I'm getting a weird echo. I think I'm getting a weird echo. I think I'll put it in a. Let me try this. Sorry about that. Okay, yeah, so this is the journal entry. I think I wasn't sharing my screen when I showed this. Okay, so if you have an accounts receivable, there's probably a matching sales that you know will be stated. So if there's a accounts receivable that's overstated, you probably have overstated sales, and that overstates your net income, which is something we want to avoid. Okay, so here is the following sales journal for close this up. For 12/31, and this is the invoice. So this is from the sales journal. So this is what they have in their sales journal. And their sales journal, remember, will lead into their general ledger. And notice that it looks like these first four differently. So these are the ones that they're going to show up in their general ledger. And you'll notice that they're sequential, right? Now, we have to compare that to the bill of lading down here. So these are the bill of ladings. So, you know, these are the ones that should be counted as sales. These are the ones that are actually shipped on the correct period. So what we're going to do is kind of compare the bill of ladings down here to what we have up here and see which ones we should count. Okay, so for the first one, this one, make that turquoise. So 3782. $37.82, so that one's fine. 37.83. $37.84. And $37.85. Okay, so these are the bills of lading that we have as being shipped out. So the question is, from these last invoices, which one should be included in the 2020 sales? Well,
It should be 82. It should be 82, 83, 84, 85.
yep. We can copy this down here. No, take out the
I'm
one.
sorry, it shouldn't be 80. It shouldn't be 85. Sorry.
And so which one should be included? Well, only those ones that are shipped. Right, these are the ones that were shipped.
Even though it says from 1/1/2021.
Well, it was shipped on 12/31. Which means that it could be that there was a problem with getting that sales order in or whatever it was, but this invoice was shipped. You know, this is a shipping document, so you know, it went out. Now, there's also the problem of this one though, because this one was not shipped. This one didn't get shipped till the 1st. So which invoices should be in that now? If all of the 2020 invoices were included in the 2020 sales, what correction would be necessary at year end? Oh, I get it. So if these invoices, the ones, you know, if all these were up here were included in the year end sales, let's just add that up just for, so these total what? I don't know, what is it? 700 plus 2100. 700 plus 2100 plus 800. 4,800. Okay, so they had those 4,800 on the sale. They should have had, let's add these up. You could also just compare the one that came off and the one that came in, but let me add these up. 700. $3,100. Should be closer together. Okay, so they have these four. They really should have had these four as the actual sales, so 3,100. So what would be the correction necessary? $1,500? So this would be, the correction would be 1,700, so reduce the sales by 1,700.
How do you get that?
From up here, I should bring these down, get it down closer together. So this is what they have recorded.
Hmm.
Let me get this on one page so we can kind of look at it together.
Oh, I see. So instead of the 2,100, you're just taking the 400. So that's a $1,700 difference. So that, okay, I understand.
Yeah. Yeah. So, you know, this one, these are the ones that should have been in there. These are the ones that were entered. And, you know, so the difference is this. And if you look at these, you know, which one of these is a bigger order, the 400 or the 2,100? Well, this one is probably an easier order to get out, you know, than this one. This one probably took a little bit more work, and that's probably why it didn't get shipped out when it, you know, whereas this one was probably the smaller one, probably easier. I mean, there could be other explanations for it, but anyway, this is what they talk about when they talk about getting a cutoff. Is they say, okay, this is the cutoff, you know, should have been at this bill of lading, you know, right here. This is the cutoff. And by the way, one of the things that you do when you're doing auditing of inventory is you'll actually go and see what the last bill of lading is for the end of the year. You know, see the ones that were the bill of lading. Remember, the bill of lading is a, you know, it's a contract. It's between the shipper and the seller. And so there's actually another party involved in it. So that is another, is a good thing, because that shows that there is, that someone can pick it up. There's this bill of lading signed by the, you know, whoever the carrier is for it. And that you can actually get that verification that that was actually shipped. And if it wasn't shipped until, you know, January, then that would be on January that it was. And it's a legal document, because basically you're transferring possession of the items, but not the title. So that bill of lading is important, because it's somebody taking somebody else's goods that they don't own. The shipper doesn't own them. And at that point, they're, you know, it's in their custody. They're liable for it at that point. Anyway, so that's what I should, yes, let's do, there's another one here. I tell you what, if we can take a break now and can come back, and if you want to work on this one, we'll say be back at 7. So see if you can figure out this one, and we'll go ahead and take a break. It's very similar to the one you just saw. And again, you know, this is where you're going to get the cutoff for those things that are sold are, you know, this is the cutoff. I want to separate these out like that.
Hi.
Okay, so this up here would be a overstatement. This one down here is gonna be an understatement. Okay, any questions on these? Yeah, so this is kind of a cutoff thing. So you want to see when the shipments are made. By the way, one of the reasons why this kind of cutoff is so important also is that it also affects the inventory. You know, those things that were not shipped should be in the inventory. Those things that were shipped should not be in the inventory. So, you know, looking back at this, you can take either one of these. You know, this item that wasn't shipped here, that should still be in inventory. Whereas this item will not be in inventory. You know, whatever these are the retail costs of, or the price of it. So we don't know what the costs of it are, but one of the reasons why the sales in the accounts receivable is so important, because that cutoff affects also the inventory. And let me put that up here. Way up here. Because along with this, there's going to be another entry that look like this. I'm making this number up. I'm not getting this from anywhere. You know, so this year-end cutoff is not just for the sales and the accounts receivable, it'll also impact the inventory. You know, because you're going to pick up the sales and the accounts receivable at whatever the selling price was, and the inventory, which hopefully is less than that. You also take that out of the inventory. Now, when you do your year-end inventory, that shouldn't be there if it's already gone. If it's, you know, if there's a bill of lading that says it was shipped out on 12/31, it shouldn't be in the inventory. Now, if it wasn't shipped out, it should be in the inventory. It's not a sale yet, and that inventory is still available. So these are, you know, they're kind of related. The accounts receivable and the inventory, because the cutoffs are going to be similar. Now, inventory will have one more cutoff. Inventory is actually kind of tough. Yeah, it can be. I don't see. Well, when I was in auditing, I don't know if I told you guys this or not, but I became an inventory guy. I think the inventory is, for a lot of companies, is huge, and a lot of companies, it's the most important thing. if you talk to somebody from Walmart, they generally don't care. No, they don't care, but the things like, you know, the structure of the store and all that kind of stuff, while it's important, what they really focus on is inventory, because that's where they make their money, is on the inventory. And inventory can be tough, you know, so you're going to have your sales cut off at the end of the year, but inventory, you also have purchases, stuff coming in all the time. Purchases. So you're going to have a purchase cut off too, which is very similar to what we just did. And there'll be those things that are received will be, you know, there'll be a cutoff for that also. So inventory is difficult because it's a moving target, you know, and that's what they are related to the accounts receivable, because if it's sold, it's no longer in inventory. And if it's not shipped out, it still is in inventory. Okay. Any question on that? Okay, and let's go with the inventory handout. We'll get started on that. And let's go. We're not going to finish it, I don't think, but we'll see. We'll see how far we get in. But inventory again is it's one of those things that is it's got so many ins and outs on it. And like you say, when I first started auditing, I think just because I needed more people to work in inventory, I worked with a few people on inventory, and then I became inventory guy. And then on all the subsequent audits, I was inventory guy. And, you know, it's just, I don't know, I didn't have any particular interest in it, but, you know, that's what I became. So let's see here. I'm going to save this. Okay. So inventory, and I didn't, for this chapter, I didn't go too much into the internal controls over the inventory, and obviously they do have them, but stuff we already know, but so yeah, obtain an understanding of the internal controls over inventory. So it's required that you get an understanding. If I make this into a complete sentence. So auditors are required to get an understanding of internal controls. If the controls are going to be relied upon, then test controls are necessary. So if we're going to rely on them, test the controls. We talked about that before. So inventory. They come in two flavors. Periodic inventory. The entire physical inventory is taken at year end, at the end of the period. You could have monthly inventories, but usually it's year end. So periodic inventory, year end inventory count, the entire physical inventory is taken at year end. Perpetual inventory. I'd probably be taken at the end of the period. Perpetual inventory continuous inventory counts. So perpetual inventory is updated after each sale. And oftentimes they'll also have counting of the inventory at perpetually to see if the inventory is correct. Large stores will do that. They have to do it this way pretty much. If you will go into if you're around like a Walmart or something that's open late to midnight or 24 hours or whatever, if you go in there 11 o'clock at night or whatever, a lot of times you'll pass aisles that will have a bunch of tags on it, and they'll have all these inventory stuff, and they'll have people come in. Sometimes they're employees. Sometimes they'll have a contract to have somebody come in and take the inventory. And what they'll do is they'll take the entire inventory of the stock will be taken, but it'll be taken piecemeal. So today we're going to do art supplies. So all the art supplies aisle will get inventoried, and they'll have people come in and do that inventory. A couple days from there, they'll have someone come in and do whatever, sporting goods or whatever it is. So they do it piecemeal. Now they should have the entire inventory done throughout the entire year. It should all be completed, but they don't do a year-end inventory. And you can imagine someplace like Walmart doing a year-end inventory would be a nightmare. And most stores are like that, larger stores. So those larger stores, you really do rely on the internal controls because you have to. And the internal controls a lot of times will be, okay, we have a perpetual inventory system. The inventory is updated after each sale. And a lot of times the inventory will be taken throughout the year rather than at one point in time. Okay, subscript test of inventory. So this is, you either did the test of controls or you decided not to do test of controls, but now you're going to do the subscript test of inventory. So these are for dollar amounts. Okay, listings of inventory reconciled to ledgers. This is usually a few minutes, and a lot of times this will actually be connected. So the listing of the inventory. Yeah, actually, I got a funny story on this one. This is one of those things that should take like 5 minutes maybe. Get the listing of the inventory. You might have one or two things to look at, but usually it's not that big a deal. I was doing an audit. This is the assembly plant, the Navistar assembly plant in Indianapolis. They made diesel engines. But anyway, they had all these repair parts and stuff, and the inventory for repair parts was one of the things that I was looking at. On that audit, I actually didn't do the inventory of the engines and all that. Someone else, the lead auditor, wanted to take that because he had looked at it before. But anyway, so I was doing these repair parts, and so I got a listing of the inventory at year end, and I look at it and it doesn't match up. It's not off by a lot, but it doesn't match up. And I was just kind of wondering, right? So I just went through, and I actually was working with a IT guy, and we went through and we found out there was a number of these accounts, a number of the prices of the inventory had changed. And I said, well, how'd that happen? And all of a sudden, everyone just starts telling me about the new purchasing guy. He would negotiate these with the vendors. And by the way, they got him in there. It was like, oh, we got this hotshot purchasing guy in here. And he had negotiated that inventory that we had already purchased a different price for it. Usually you negotiate going into the future. Well, I don't know, he took him on. So anyway, he went back and told them that they had to change this inventory amounts from the previous year. And they all told them, no, we'll just put it through as a credit, because that's what we paid for it. Most of his inventory had already been sold or used or whatever, so. And he was just very insistent. So finally they said, okay, we went through, and they went through and they changed the inventory. You think you're going crazy because like go back and we actually talked to this guy. And by the way, he actually left. He wasn't fired, but he actually left while we were doing the audit. And we told him, well, why don't we put it through as a credit? And he said, well, that's what they were saying, that we should put it through as a credit, but that's not right. I got them to come down on these prices going back into 6 months into the previous year. And so it was just a really weird thing and again, it wasn't like it was material. It wasn't off by a ton of money or anything like that, but it's just very strange because usually it's like I say, it's a few minutes and it ended up taking up like half a day. Okay, evaluate the client's planning for the inventory. The big thing here is the I don't need to coordinate the physical taking of the inventory with the client, and that is that. Excuse me one second. Okay. So when they take an inventory, who's going to be there? The people who actually take the inventory are going to be the operations people. You're going to have the accounting people there. You're going to have the external auditors. And the internal auditors usually. So the operations are people that actually take the inventory. The accounting department, external auditors, and internal auditors, these are people that all oversee it. So the accounting department doesn't do the inventory. And if you think about our segregation of duties, right? Custody of assets, authorizations, and record keeping. Auditors taking, or accounting department taking the inventory is a no-no because they would have custody of the assets and doing the record keeping. So operations people will take the inventory. Watching them will be the accounting department. They'll probably be the ones that be most involved. They'll be the ones that are actually, really getting in there and getting the numbers and all that kind of stuff. Then you have the external auditors and the internal auditors. The external auditors will probably do the least, but just because their scope is only on the financial statements, whereas the internal auditors will be looking at things that maybe aren't material, but maybe need to be corrected or whatever. So, it's not uncommon to have three, different groups of people watching over, observing an audit. Sketch it, observing an inventory. Okay, observe inventory and make test counts. Okay. So, and I'm kind of getting ahead of myself a little bit here, but generally they'll have, if you see someone do, have you guys ever done inventory in the store where you have especially for retail, like the SKU numbers?
I have.
Yeah, yeah. So you know how it kind of goes. You'll have a sheet, and they'll come and someone will have they could use sheets or tags or whatever, and they'll go through the store and they'll put like a tag on some group of inventory, and then they'll have a count sheet that goes with that tag. Sometimes they're the same, sometimes they're one and the same. But anyway, so what will happen is, and the reason why they do that is obviously that they want to make sure that everything's counted. So everything that needs to be counted will have a sheet on it. And those sheets will be numbered, so to make sure you get them all back. And that everything gets counted, and that everything gets counted only once, because there's going to be one sheet for each thing. So as an auditor, what you'll do is you'll go in there and do test counts after they make their counts. So they'll do test counts, and maybe you'll observe them doing the test counts, and you go through it and count exactly the same thing, you know, see what the tag number is on it, write down this is the tag number, and then see if the counts match up. I don't know, in your situation, so you get a varying degree of people how interested they are in taking the inventory, depending on what the situation is. You know, sometimes people are very diligent about it, and sometimes people, you know, they could care less if the place burns down. You know, it wouldn't matter to them. So, you know, you do run this the variation, but anyway, doing the test counts though, you match it up with whether with the whatever they have for that tag, and that'll give you some information about how well the inventory was performed. So, and again, we don't look at everything. We don't count all the inventory, but we will make test counts. And generally, you know, you do try to stay out of their way because they're the ones that are actually doing the work. And you just kind of, you know, we'll go through there and pick out some of them that you're going to do test counts on. Okay, review the cutoff of purchases and sales transactions. And receiving, well, we already talked about the sales transactions. So let's do the purchases. The purchase cutoff focuses on receiving reports. So receiving reports, you know, obviously when they have a receiving report that comes in, that will be kind of the guideline that you'll have there as far as what should be in the inventory. And the danger is that they'll receive something and put it in inventory, and but then it won't actually show up as in the inventory account. If you overstate your inventory, you generally overstate your income, because, you know, you think about it, that means there's more assets on the books than there should be. The balance sheet has to balance, and that usually comes out of the income, that it reduces the cost of goods sold. So you're always interested in those things that are in the receiving, you know, that have been received, that are not actually in the physical count of inventory, even though they should be. So those things that are in the receiving report, any receiving report as of year end should be included in the physical count of the inventory. And if they're not, it means that the inventory could be overstated because those items are not listed in the inventory, but they'll be included in the count. So if you have a count that's higher than it should be. Now, do you guys want me to show you how that comes about? It's basically like this. If it has to do with cost of goods sold. I'm just making these numbers up. You have beginning inventory, you have purchases. Inventory available. Oops. And then you subtract out your ending inventory because your ending inventory is not sold. So let's say the ending inventory was so your cost of goods sold, maybe it should be 7,400. So not sold to 600. I had to sneeze. All right. Okay, so here's the problem you can have. If you overstate this ending inventory, you know, if you say, oh, okay, ending inventory is not 600, it's 900. Right? Then this goes down to 7,100. So for the same sales, you're gonna seem like you're more profitable. So this overstated ending inventory will actually a lot of times come out in looking and making your income look higher than it really is, because there's this inventory. The larger this inventory that's supposedly not sold is, the lower your cost of goods sold is. Okay, so you know that's why the cutoff is very important in the receiving report and those things. Anything in the receiving report. Okay, obtain a copy of the completed inventory. Click check to test the clerical accuracy and trace test counts. So again, you know, the big thing there is the test counts. You will also check the clerical accuracy of it. Don't get me wrong, but unless something strange happens, that should be pretty much. Okay, 6 and 7 are actually very, very important. Be LIFO, last in, first out. FIFO, first in, first out. Average cost. There's actually dozens of ways to do inventory, but those are, you know, sometimes they'll have cost pools and stuff like that for the LIFO, FIFO. But you gotta get familiar with how they're actually pricing it. And then test the pricing of inventories. And this is actually very important. Because there's two problems with the inventory. And the two problems are, there could be a problem with the count. You know, the number you're actually counting is off. And the number, and also the price that's assigned to it. Now, if I were a criminal, I would not try to inflate the inventory by the counts. because that can be caught. You know, someone could, it wouldn't be uncommon for somebody to be able to figure out that the counts are off. It's more difficult for the pricing. So manipulating of the pricing is actually a trickier thing to find. You know, and you get the video with Anthony and that you know, that was the problem that they had. They had the problem with this inventory and their pricing of the inventory, you know, of valuing it, and that was like one of the things that really tripped him up, was that the actual assignment of it, not necessarily the counts. The counts are, you know, whatever they are, but the pricing is actually much more difficult to figure out than simply the counts. Now, you know, have places, you know, put empty boxes on the shelf, yeah, but that's usually not that's one of those things that can be caught, and you know, probably not the smartest way of doing it. Okay, so test the pricing of the inventory. So test the pricing of the inventory. Perform analytical procedures. This is one of those things that, you know, you're going to talk about ratios. You know, this tell you things like turnover. The one thing you can do is compare those to industry average. This one is important too. Remember that ending inventories have been pledged. Okay. Let's do the assertion of rights. It's possible. You count the inventory. You do the pricing on it. You price out the inventory. However, that inventory may be pledged for, say, a loan or something along those lines, and that it's actually not available for sale. So it is possible that it's not available for sale. And sometimes these loan agreements are that they can't be sold unless the bank approves them being sold. The bank doesn't want them to sell the inventory for, say, for less than the cost of it or something like that. You know, the bank's interested in getting their money back. You know, they'll loan you money for the inventory, but sometimes, depending on the agreements, they may have to clear it with the bank before they sell that inventory. So maybe restricted and not really available for the general, you know, sale the way you normally would. Normally you can sell inventory for whatever you want to sell it for, but it's possible that if there's a bank involved that you can't do that. Okay. Final statement cost goods sold, including the adequacy of disclosure. So the disclosure is all inventory does not have to, you don't have to keep inventory all using the same method. For instance, when I was at Navistar, we used to have the inventory for trucks and engines and all that used to be LIFO. And the parts for repair parts and those sorts of things, maintenance parts, those are all kept on average cost. So you don't have to have them exactly the same. Those are all kept on average cost. So you don't have to have them exactly the same. Okay. Well, one of the things here, the evaluation of the client's planning for the inventory. Let's go down here. Now, I'll click on the best dates. I'm going to leave. You guys kind of know that one. But I do want to put one thing in here, and that is interim inventory counts can be made if the controls are adequate. And it's a big if. So they do inventory throughout the year. They can do interim dates, that they do it throughout the year. And as an auditor, you'll go observe them doing this, in March. March 13th, you'll go watch them. 11 o'clock at night, you'll go and watch them take inventory. If the controls are adequate, if they're strong enough controls, you can rely on those. If the controls aren't there, if you don't think the controls are adequate, year-end inventory it may be necessary.
How is inventory actually decided though, the dates?
They need to come up with the days that work out for people, and it can be, it isn't always at year end. It doesn't have to be at year end. It could be when they, if Sunday is on, 12:30 or something like that, they may do the inventory on that day and simply back into the numbers for the last day. Get a good cutoff and back into the numbers. So a lot of times it's working it out with the auditors. And the problem you have doing that is that a lot of times these audit firms obviously have more than one customer. And so how do you get enough people to observe inventory at 10 different customers on the same day? I have seen auditors running around on December 31st, going to different places. We have to observe this inventory in the morning, and then in the afternoon we go over here and observe the inventory and all that kind of stuff. But yeah, we're working out the dates. And if it's throughout the year, it's not, obviously you can, it's not the rush that it is at year end. But doing it throughout the year, a year-end inventory is better evidence because it's, obviously it's done all at once, and that it's better evidence. So if you don't think you can trust the interim counts, you can request them to do a complete inventory at year end. But again, for a lot the larger companies, things like Walmart, Target, well, they will do some stuff at year end. A majority of their test counts are going to be throughout the year. But yeah, it can be a problem deciding on that. Because again, a lot of times clients will have the same year end, but again, a lot of times they'll do it on days that they're that they can close up the place or close it up early and then do the count. So sometimes it's not always at year end. As long as you can back into the numbers, you can do it. Usually it's within a few days of the year end though. But yeah, it's hard to coordinate, especially with the external auditors. Internal auditors and accounting department usually isn't a problem, but the external auditors run around. So yeah, and a year-end inventory is better evidence. Suspending production in certain departments or plants, and this also kind of leads into the best dates. A lot of times, if you can suspend it, either a lot of times inventories are done after work hours. Sundays, if they're not open on Sundays, etc. You're a lot of times you're trying to get things to stop, and especially for things like inventory, because inventory is a moving target. Stuff is coming in all the time. Stuff's going out all the time. So it is really nice if you can stop and say, okay, no more sales, no more receiving. We're going to figure out what this inventory is now. So if you can do it, shutting down the operations is very helpful. Sometimes you can't do it. For instance, like one of the things we have at US Steel, we made steel, obviously. You can't shut down a steel furnace. If you shut down a steel furnace, you're talking about millions and millions of dollars to restart it. So steel mills, they produce steel continuously. They run 24 hours a day for years. And it's because you can't shut them down. And if they do shut down, it's gonna hit their financial statements as some kind of a loss. So sometimes you can't shut it down, but steel's kind of an awkward thing. But anyway, yeah. So if you can stop the operations and stop things from being received or sold, it really helps to get that good cutoff, and you can then you're free to go ahead and make counts without more inventory coming in and being loaded on the shelves and all that kind of stuff. Segregating obsolete inventory and defective goods. And what you don't want to have is someone counting inventory that is defective or obsolete, for whatever it is, from the rest of it, because a lot of times the pricing will go based on the inventory counted as a whole for it. And when I was at US Steel, they would have inventory that was, this could be boring, but steel comes in different grades, and so sometimes they'll have steel that is, it comes out like a big tube of toothpaste. They throw all the stuff, the iron ore and all that comes out like a tube of toothpaste, and there's different formulas for like making cars, there's different formulas for like making appliances and all that kind of stuff. Anyway, when they're switching over from one to another, a lot of times there'll be a big, hunk of steel that comes out that really isn't consistent. And there's a market for it. It's called secondary steel. But anyway, depending on what that is, it can be segregated away from everything else and say, look, okay, this is not, the high value auto industry steel. And it's not the somewhat high value appliance steel. It's something that we got to sell to somebody who's making, I don't know, buttons out of it or something, whatever they're doing that is not, critical. So a lot of times you'll have things like that. We had those things that we segregate the steel that way. And one of the kind of humorous things about it, as auditors, you're always curious if, they pick up that steel, so we would, and I remember that we had this one big slab of steel that was, whatever it was, say defective, but that it had issues, it wasn't the top grade stuff. And I remember we all counted it. I think it was, you talk about things being double counted. I think it was counted something like 6 times because everyone thought that everyone else was going to miss it. And there was this one big hunk of steel that was the most, it was almost, was the least valuable steel there that everybody counted it because they thought everyone else was going to miss it. Okay, establish a control over. We kind of talked about this a little bit. Inventory tags or sheets. These are pre-numbered. And one of the humorous things is they always talk about being serially numbered, but I think it's funny because it's like, how else would they be numbered? But pre-numbered, serially numbered, and every one will be accounted for. So, they go out and again, it could be sometimes they have the count sheets right on the inventory. So there'll be an inventory that have a count sheet on it, and you go take that count sheet, count the inventory on the sheet, and turn the sheet in. Sometimes they'll just have tags, and usually they'll do something along the lines of they'll take the tag, they'll put it on a generic count sheet, but say, okay, this count sheet is for this tag. It's the same thing. It's basically accounting, making sure that everything gets counted. That everything gets counted and that everything only gets counted once. So, and you gotta let the people know, that there'll be a tag on it, they'll count the inventory, and then they'll start wandering off and start counting other stuff. No, you can't. You just gotta count the inventory that applies to this sheet. Don't start counting everything in the place, just the stuff that's on this sheet. So, yeah, and it's just basically there to make sure that everything's counted, that everything's only counted once. You have to find all those sheets, and that hopefully someone's keeping track of where they were and where the sheets were actually positioned on, numbers 600 through whatever are here and whatever, however they do it. But basically it's there to make sure that everything's counted and that everything's only counted once. That's the most important thing. And again, this, just to kind of not drive the point in too far, but this is simply for the physical count. This is not for dollar values. Now, as auditors, you are always on the lookout for things that maybe are damaged or obsolete or whatever that hasn't been separated. You'll check to see if there's any of that in there. But mostly, these are for the counts, not for the values of it. So it isn't the entire equation, basically, are these inventory tags. Okay. Achieve proper cutoff of sales and purchase transaction. Is that one already up here? Okay. So cutoff of sales, purchase transactions, those are cut off by the receiving reports. And rating for the services of engineers or other specialists to determine the quality of certain goods or materials. So some of these engineers are specialists. They'll tell you something funny. US Steel, we used to do, they used to have tons of iron ore. It was like, I mean, hundreds of tons of it. And they'd have it in these big piles. And they'd actually have, they probably use drones nowadays, but back then they used to use airplanes and they'd take pictures from different angles. And then they'd work out mathematically how much iron ore there was there. So, they know that, okay, it's this tall and the slope is this much and it's for this big, and they would work out the volume of the inventory doing that. And that was obviously something that, we didn't fly airplanes when I was an internal auditor, and the external auditors didn't fly them either. So that's a specialist that would come in and evaluate the inventory, based on, using photography to kind of work out how much iron ore that they had, because they used to have, it was something like a half-mile long trough that had iron ore in it. I mean, it would be impossible to do it really any other way. Another thing is like the quality of the steel in that. And there was an operations guy, and he had the best job, I think. Well, usually the best job he had, it probably was extremely boring. But he was very high up. It was a union job, but his whole job was to evaluate the different types of steel that was rolled, in the sheet, in the big coils. And he had this little knife, and you would go and say, okay, here, this should be prime A2 steel. And you wouldn't say that to him. You'd say, what is this? And he'd take this little knife and he'd cut a slot in it, and he'd look on, open up on it, and he'd do his little stuff, and then he'd shut it back up and he'd say, okay, that's prime A1, 2 or whatever it was. And that was his whole job. And then he would go back and he'd sit at the desk and sharpen his knife and listen to the radio the rest of the day. But anyway, he was a specialist. I mean, he knew what the composition of different types of steel were, and that was his whole job, was to go through and evaluate and see what those steel were, and it could be significant. The difference between different grades of steel, steel for the auto industry compared to, say, the appliance industry, auto steel is 3 times as expensive, because rust proofing and all kinds of other stuff, structural stuff. So, it made a big difference. I look at those 2 coils, they look exactly the same. They're both wrapped, they look exactly the same and all that kind of stuff. Whereas, someone who specializes to do that. Okay. Let's just stop there. We'll stop here. Okay, so I think, so what I'll do is next time I will, we'll finish up the chapter 12 and 13, and I'll make a test for that. And it's not as, like I say, it's not as tough as the cash one. And then we started in the property, plant, and equipment, and we'll see what we get to the end of the audit procedures. Whenever we get through on next week, that'll be the end of it for that'll be the last test or whatever. Maybe we'll even vote on it. Maybe it'll just be one test. But anyway, we definitely want to cover chapter 13, which is property, plant, and equipment, and that's probably the easiest of all of them to go over. But and then that'll be it for the course. Any questions? Okay. So nothing to turn. Wait, no, there is something to turn in. The chapter 11 handout. Oops. That will be due on 21st? Nope, 22nd. So that one we just finished up today. Make sure that that's in there. I did not get to you guys grading. I will do that probably tomorrow. I'll get to it, and I apologize for that. Okay. Okay, question? All right, have a good evening, and I'll see you guys in a week's time.